Welcome back, everybody, to Movified. I am your host, Mark Hirschi, and it is Movified Mondays. Welcome, Brock Hartzler from ProMover Accounting. How are you?
I'm doing good, man. I'm doing good.
Your name has been popping up left, right, and center. It feels like every guy in the industry and gal says, great, I've started this moving company. I think I'm making money. I think I might be losing money. Where do I go from here? How does this work? How does this whole, P&L statement make sense to me? Because the last time I had to read numbers was a receipt at a restaurant, not, not some income statement.
Yeah.
We as moving company owners are heavily super overwhelmed when it comes to looking at financial statements. I want to jump in this first question, then let's dive deep into who you are. What are some key breakdowns? Like, I want to get right in here, of the profit and loss statement where we should be focusing on monthly, to assess our financial health. Like, what's something that we should make sure, because everybody, and I kind of want to broaden this out, all are not just using QuickBooks. A good chunk of them are. Maybe you're using Sage, maybe you're using some internal accounting system. Maybe you're still using an Excel graph. What are some of those key components that we should be looking at when we're looking at a P&L statement?
We use QuickBooks Online for so many people. There's people that love it and hate it, but it's kind of the universal system. So many people use it. But then there's Xero, there's Sage, like you mentioned. Number one is making sure that you're doing it all the time, right? There's so many people that their accountants do it once a year and you're not making decisions on that, right? So kind of leading into the answer to your question is, first and foremost, you have to have stuff timely, right? Now you have a system. Now you have it timely. All your financial instruments, your bank accounts and credit cards are mapped in appropriately, right? You're reconciling, you're doing books, or somebody is. Now you're getting the numbers and what are you doing with them, right? And really that's where, I don't mean to go into ProMover right now, but that's really where ProMover kind of came about. Is so many people are just looking at their P&Ls. Unless you're an accountant, it's kind of difficult to read and understand what it means, other than the net income. For the most part, people know what the net income is, which can still get you tripped up if you truly don't fully understand what the net income means, because it's not cash, right? Looking at your financial statements, really, you need to make sure that you're continually improving. So whether you're using industry metrics, or your own metrics, you just need to make sure that you have metrics and that what you're doing is improving on the metrics. One of the big things that we're looking at all the time is direct labor as a percentage of sales, right? That's kind of the low-hanging fruit. And we include direct labor, the taxes associated with direct labor, or contracted labor, which doesn't have taxes, payroll taxes, right? And then workers' compensation, right? And that can vary depending on your location. California, sorry guys, because you guys are getting swamped in your workers' compensation. But we include all those numbers in the labor numbers. And we want total direct labor, which are the sum of all those numbers, to be less than 34% of total sales. That's what we're shooting for. And the reason that we shoot for that is because we build our metrics based on, your sales is 100% of the pie, and we're chipping away at this pie with different parts of the income statement of the P&L. And not to get, to accounting jargon talk, but you have to allocate a certain amount of the pie to that. And so we say 34%. You may be different depending on how you do your accounting, but either way, number one, you need to be looking at the numbers and you need to be able to spot an issue when it arises or before it arises, right? So going back to your original question is kind of what do you look at when you're first starting? You're just looking to make sure you're improving. And if you're not improving, what do you need to do to improve? Or what are the issues that are making you stay the same or not improve?
You started doing this for moving company owners back in 2019, right? Give me a little bit of a history, Brock. I bet you that big open question, you have guys that are listening to his going Brock, okay, tell me some more. But what makes you the master behind this? Give me some history on who you are, why I should trust you, why I should even believe anything that's even coming out of your mouth, and you're not just, ChatGPTing this whole list of answers to me. Yeah. Give me a little insight on ProMover Accounting and what you guys all stand for.
100%. Well, hey, first off, you shouldn't blindly trust anybody. You shouldn't blindly trust me. But the big thing is the concepts that we use are not new concepts, right? We just take fact and basically say, here's the fact. Like it or not, this is where you're at. This is the truth, or this is the averages that we come up with, right? So we started ProMover back in 2019, kind of the end of 2019, and it really stemmed from a good friend of mine and brother Tim Krupp, who owns a moving company called Krupp Moving and Storage. And my
Never heard
late
of him.
father, what's that?
Never heard of him. No, I'm joking.
Never heard of yeah.
Show it to Tim.
Not a guy worth
fantastic.
He's
Put
a
on the show.
wonderful
Yeah,
man.
exactly. Who is this guy? Yeah.
And my father did his accounting and his tax, and I was a partner in that. And Tim kind of came to me. We did some unique things for Tim and gave him some cool information. And basically out of that, he said, I think that what we produce for Krupp Moving and Storage would be super beneficial for people all over the country. And so out of that, ProMover Accounting was born, and I started tailoring these financials or these metrics to moving companies and looking specifically at what makes a profitable company, what is a hindrance in a moving company, or what are some of the things that we see that the companies that are struggling, what are some of the issues that that are recurring. And so we only work with local moving companies. And the coolest thing as of late that we've been able to build is we obviously, we look at all of our companies and we weed out some of the ones that are a little unique, or maybe they have van line revenues or things like that are just a little bit different. And we're able to build the average of, I think the latest report was the average of like 60 moving companies, just to look at the averages of everything. Now, obviously, we don't want our clients to be average. We want them to excel. And the average moving company generally that we see breaks even, right? To be honest. And so we want them to thrive and to have a positive earnings. So our target metrics are basically to say, we at least want you to have 10% net income. And so what do you need to do? What does your income statement need to look like in order to reach 10% net operating income? So anyway, from 2019, it's grew into this really cool business with, I work every day with people that I absolutely love, clients that I absolutely love, getting involved in their life and getting involved in the company and then the nitty gritty through different services. But it's provided a solution for a lot of moving companies that allows them to see where are they thriving, where are they falling short, and quickly, what do I need to do to improve the profitability of my moving company, right?
Hi, I'm Mark Hirschi with Salmon's Moving and Storage. Today, I want to talk about Tighten Up training. Why? Because this is Netflix grade quality training. It's not those old videos and VHSs that you got hiding in your office somewhere. It's online, it's easy to use, they're short videos, but they get to the point. My new employees, these guys run through these training programs, there's tests at the end, and they're coming out going, oh, I'm ready to rock. So if you haven't checked out Tighten Up training yet, get a demo done. Get on board. Guess what else is there? Online portals for my sales staff. Can you believe it? These guys can learn how to overcome objections and book more leads today. So what are you waiting for? Go check out Tighten Up training today.
I love it. And, I'm so happy that there is someone like yourself that's out there. I remember, and it's been years now, and I still kind of run through the same hoops up in Canada where, to have an accountant that understands moving and has some type of idea by working with other moving companies, you kind of want to have that person hold on to them, because you can have an accounting company that says, oh, I work with a transportation company, or I've worked with, a painting company, and I've worked with some people in the trades. It's all fairly similar. It's all the same. Everybody wants to see that profit at the end. But I find I always love the creative ways in how to save money and how to write things off, and how can I do this? Because I always think, if the rich guys are doing it and they are constantly saving money and they somehow are writing off all kinds of taxes, there's got to be ways for us to be able to do it as well too. So kudos to you. Thank you so much, Brock. This has been a pleasure. For everybody listening, that's all we have time for today, and we just really wanted to hit that one question. No, I'm just joking. I kind of want to jump right back, to this P&L statement, right? I mean, in the industry, I want to give us 3 tiers. Okay. There is the guy that has one truck just starting out, and he is, man, I doubt this guy is, and gal, there's girls and gals that are in the industry, are really actually going to an accountant saying, how am I saving money? And here's all my receipts and my invoices and stuff, because half the guys probably are not even on payroll. And you're going to have individuals that are just pulling their hair out because they don't know where their money's going. Then you have the middle tier. We're going to talk about all 3. You have the middle tier. The guy or gal has the moving company. Let's just use the moving company now, has, let's say, 4 or 5 trucks. They're established. They're probably doing, let's say, $1 million to $2 million in sales. They find themselves fairly successful because they're turning a profit. They've been in business for 4 or 5 years, and they are getting, a financial statement at the end of the year. They are working with an accounting firm, but at the same time too, that accountant is talking Latin to them, and they're going, sure, okay, this all makes sense. Do I have a profit? Like, why does this tell me that I have $100,000 at the end of the year and there's only $1,000 in my bank? What is happening? Then you move to another step, the final step, and it's a split. You have the big company that was an independent moving company. They're doing successful. They might have a couple locations. They obviously maybe have an in-house now, like a CFO maybe that they work with, an in-house accounting team that they work with, and they're figuring out their numbers and stuff. But they seem to now be making less of a profit because they're much larger, as opposed to when they were smaller. Or you break it off and say, now they're also part of a van line. And now they're working with van line numbers and going like, how the fuck does this work? And their tariffs and their margins and everything else are so much different than my margins. So these are the big areas I want to touch on. I hope you have 4 or 5 hours to spend with me, because we've got a lot to cover. Let's start with the first guy. Let's start with the little guy. What is he looking for? Right? Like, what is something that he should be focused on to say, hey, I need to figure out XYZ in order to at least know what my numbers are.
For moving companies that are doing less than $1 million, right? A lot of times, especially if they're doing less than $500,000, a lot of times the movers on trucks, the owners on trucks, right? They're actually still performing moves. Sometimes I'll see people that are doing less than $1 million in sales. They're doing some sales. They're doing ops. They're also on the trucks, right? And man, you can see a lot of people make a lot of money doing that, but more than anything,
they're doing 5 positions.
Absolutely. Because they're working, the amount of 5 people, and you can make a lot of money doing that, pull your hair out, and you're looking to grow, but mostly because overhead is 0. And kind of a recurring theme as you think about make parallel the theme of growth and overhead expense is overhead expense is that recurring theme that keeps popping up that blends into profitability. And we can talk about that. But for a lot of the movers that are under $1 million, you run into this really strong issue of, I want to get off the trucks. I want to get into the office. Yeah, maybe I want to do sales, or maybe I want to bring in a salesman, but now ops are a lot. I want to start bringing in ops. And you're kind of at that difficult point where it's like, I want to hire people, but there's too much month at the end of the money, And so a lot of times what we'll work with our clients on, especially the ones that are under $1 million, is we're looking for how much the owner can take. And what do I mean by that? If you're doing $1 million, you're an investor in your company as an owner, right? But you're not able to pull what you can pull from a larger company. And so people want to be making $100,000, $150,000 when they're doing, $1 million in sales. Well, you're taking 10 to 15% off the top of your sales. So whenever we're looking at our margins and our metrics, we say that administrative labor, not sales labor and commission, but administrative labor should be no more than 10% of total sales. So if you're doing $1 million, 10% is 100,000, and that includes tax. So if you're trying to pull 100 grand, you are the only admin, right? You're maybe not sales, but you're ops manager. You're the guy running the entire show, and you can have no help in the office other than sales, right? That's your job. It can be really difficult when the owner is taking all that 10%, taking a lot of money out of the company, and now you're trying to grow, but there's no money left, right? So it's a really difficult position for a lot of people to be in, is to get over that hurdle of 500 to 1.2 million to get up to 2 million. That's generally the hurdle, is hiring the right people, but also not overstepping your bounds. I've seen one guy in particular that went to $1 million faster than anybody I knew, but he was sleeping in his truck. He had no overhead costs. And so as you grow your company, really monitoring those overhead costs to make sure that while you're still young, while your company's still, under $1 million, that you're not bringing on too much admin burden or too much overhead burden, because you need to be putting that money into sales and growing that top line, right? While top line doesn't tell the whole story, you can have a lot of sales and be negative. You can only make so much with so much top line, right? So thinking about the metrics to look at, and generally what an owner is going through whenever you're under $1 million in sales, is a lot of times you're running the whole show, you're wearing a whole bunch of different hats, and that is just the game that you play. You have to learn them all still, right? So you see these guys doing 5 million, and you see that they don't have to jump on the trucks or take the sales calls. Well, they did what it took to get to 5 million. And so you're going to have to do what it takes to get to the 5 million, right? Or get to the 2 million in this case. So again, the metrics to be looking at are predominantly administrative wage, which should be under 10% of total sales, along with all your other metrics, but keeping that overhead very, very small. Another thing I see a lot of moving companies get into is smaller moving companies, is they decide, okay, I need to be doing storage, right? And so they'll go out and get a warehouse cost, or get a warehouse. Well, if you get a warehouse, now you have this overhead cost that whether you have revenue or not, you're paying for, right? They don't realize how much of a cost that is, as opposed to, solving storage in another way. For example, a lot of times what we recommend is going to a storage facility and actually space by space leasing, if you can set up the agreement, leasing space for your storage customers to be able to rent. While you generally won't have as much margin as a full warehouse, you also don't have the risk, right? If you have an empty warehouse, you're paying rent whether you have the revenue or not. But if you don't, and you're kind of subleasing the space, you don't have as much margin, but you don't have risk. That paired with reviewing administrative overhead and such, those are really the big things from those smaller companies.
I'm doing under $1 million, rent a truck or two just to try and, get that extra revenue in here, because, for one truck to be producing 1 million seems a little bit unrealistic. And you find myself on the truck, more or less. I'm answering the phones to do the sales. I am running the operations. I might have somebody that I know, whether it's a mom, a girlfriend, a coworker, a family friend that says, hey, yeah, sure, I understand QuickBooks. Maybe I can help you do the books. So you're paying them at a part-time basis and everything. But I'm running out of my house. I'm parking my truck at my house. There is very little overhead. What are some of the numbers that I should be writing down to start saying, okay, like, this is what we're doing? And obviously I'm paying myself, handsomely, because I'm charging $150 an hour for 2 guys in a truck, for example, let's just say. So, if I think of divide and conquer, I'm thinking $50 for the truck, $50 for my helper, $50 for me, right? To use like even numbers. And I want to talk about how to work out hourly rates that make it a profitable sense, because that's 2 different options that I also learned in the past. What is something I should be writing down though to say, okay, well, I want to eventually hire somebody else to start doing sales because the sales are becoming too much. I'm on the trucks. The customer's starting to notice that I'm answering the phones too, like more often than I should. I might be missing out on leads in the office as well too. So I want to hire that salesperson. Where should I start to figure out my budget to start going? Okay, if I was making 20,000 a month extra, that just seems to go in my bank. How am I allocating this, and what budget should I set myself up for?
Are you a mover looking to make an impact? Discover Moving Letters AI and join the ML Plus Club today. Elevate your customer engagement with the personal touch of handwritten letters.
If you want to take your company to that next level, it's the only way to subscribe. If you're doing anything but Moving Letters AI, you need to get on it. So it's going to take your business to that next level. You're going to see an increase in that revenue. Let's go.
I highly recommend using this company. They're amazing to work with. They even send you an email on how much work they're producing for you.
Don't miss out. Join the revolution and start making moves that matter.
Put a golden damn ticket in there with Moving Letters AI.
Your moving software does the basics, but have you seen SuperMove? It's the most comprehensive solution out there. SuperMove has automations that respond and follow up with leads for you, even when you sleep. Don't want to do an on-site estimate? Use SuperMove's virtual survey to get all the information you need without leaving the office. Once the crew is on their way, the customer gets a live link to follow along their route, which means no more last-minute phone calls asking where their movers are. Crews can indicate when they arrive at the location, use the app to walk customers through a digital bill of lading, fill out timesheets, and automatically calculate all job expenses, including drive materials and tax. Click the promotional link in the description to schedule a SuperMove demo.
Yeah, love that. So again, while you're running on those trucks, you're running on low margins, you're running on low overhead also, which is nice, right? Whenever we're thinking of pricing, for example, is something you touched on. An easy way to think about it is that you want to walk away with a 50% gross profit margin. So 50% gross profit margin means after all of your direct expenses are paid, which
define direct expenses.
Yes.
So let's define that.
Direct expense would be your fuel cost, your cost to rent the truck, your labor cost, right? Damage claims. It's nice to throw in something as a, potential damage claims. 1% generally is good enough, depending on the size of the company. Things like that. Parking and fees, tolls, right? Whatever those expenses are, you want to pay no more than 50% of the job to go to those expenses. So if you do a job that's $1,000, you quote $1,000. We don't want you to pay more than $500 towards those costs that you can perfectly allocate to that job. Now, how we do accounting is we don't include marketing in that. There's a billion different kinds of marketing. And so we don't include marketing and direct costs, right? So you're talking your laborer, your fuel, your truck, your, maybe a budget for damage claims, your tolls, things like that, right? If you can walk away with 50%, then you're doing good. And again, how we do is we want you to walk away with at least 45%. So there even is a 5% margin for error there. But if you're walking away with that, then you know that you have that difference, whatever your sales are for the month, to be able to pay for any overhead. So if you're planning to do, say say you're doing $500,000 a year, say in a month you're doing $40,000, in sales. That basically means that half, 20,000, is going towards your truck and your people, your direct laborers, right? Your fuel cost, your any damage claims you have, or tolls and parking and things like that, for example. And you're walking away, you're paying $20,000 for all that stuff. Now you have $20,000 back. So now where does that other $20,000 go now that you have after you've paid all those costs? Now you're paying your rent, your insurance, your accounting fees, you're paying your other overhead costs, your administrative labor, which you as the owner are potentially that administrative laborer, right? So as you're doing these jobs, whenever you're pricing, you just want to make sure that you can charge whatever you need to charge to be able to at least make 50%, to be able to at least keep, for overhead cost purposes, 50% of the job, right? And generally, as you begin building up that your company, it's pretty easy to be able to cover some of those expenses until you begin to get the office, right? And then you need a car for your salesman. And so you go out and buy a, car so they can travel around and do in-home estimates, right? Now you start chipping away at that overhead cost, and that's when you can get yourself into trouble. But, back of the napkins.
That's that 50% starts dying down more and more and more.
Real quick. Yeah.
And you're allocating also your marketing costs, and with marketing, you're thinking, and when people think of marketing too, let's not forget that marketing isn't just the advertising that you're putting on Facebook or Google, or on, mail outs or banners. It is your t-shirts, it's your pens, it's your, notepads that you're getting, it's the water bottles, it's the coffee cups, it's anything that is related to marketing. It's all of the branding that's associated with your company. And don't forget, it's also when you want to decal your truck and wrap that truck, you better allocate the pricing in that too. Yes, it's a walking billboard, but it also is going to cost a pretty penny to wrap that truck.
Yeah. Something that we came up with a while back, as simple as it sounds, but for our advisory and fractional CFO clients, we came up with something called the recommended minimum cash balance. And basically the calculation is we look at what the cash trend was the previous trailing 12, right? So generally this time of year, or in January, this time of year, a lot of times your cash is kind of depleting a little bit. You're not really getting much reserves. So we take into consideration the cash degradation. And then we also take into consideration what we call one current ratio. So a current ratio of 1 is basically the cash it takes to operate your overhead costs for a month, right? So, your marketing, your admin staff, your rent, all those costs for 1 month. So we come up with this recommended minimum cash balance. And from that, now you really have simple freedom to be able to say, if I'm over that, I can spend it on whatever I want. I made this company so I make money. I can pull it out if I want, or I can put it into buying trucks, right? I can put it into buying a location. So as you're small, it's really necessary to make sure you maintain that cash balance. You don't pull it all out. You might have to live like a pauper for a little while, but all business owners have lived like a pauper when they're starting, right? It's
100%.
just the price you pay, the ignorance tax you pay while you're learning to build a company.
When you are building that company, I am now happy to say I'm making a profit. I'm doing well. I've taken the notes from Brock. I've looked at my, 2024 and figured out what my fixed costs are already for January. I know already for February and March. I'm already doing some planning and said, okay, we've been in business now for 1 or 2 years. So I have some type of idea of what sales look like in each month in my home dominated area that I live in. And I want to grow. I want to hire a salesperson. I have enough money now to hire a salesperson. Am I buying a vehicle? Am I leasing a vehicle? How are my write-offs on that? How am I writing off business lunches? How am I, I have a young family, and me as a business owner, do I put myself just under payroll so that the bank will look at it differently when I want to buy a home? Because as I'm that guy that, I decided I worked for a moving company and I'm going to start my own moving company. And now I'm actually doing pretty good. I would love to buy my first home. My wife has a child on the way. We're on our second kid. Like, these are probably all the things that you hear about, Brock, all the
I've
time
been
over
there.
the years, right?
Heck yeah.
And they go, well, if you were just taking a dividend every month, those are the taxes, extra things you're going to look at. The bank might not look privy to that, as opposed to being an employee. Give me some ideas. I want some of that creative juices that you'd be giving someone like myself that says, okay, Mark, we're going to hire this salesperson. You got some money. You've been doing good for the last couple of years. You want to grow now from that $1 to $2 to $3 million business. And here are some nice savings, ways to save some money, to write off some expenses that I would recommend to anybody in your situation.
So we can go down a rabbit hole of tax savings and such, right? And I will also say I'm in the U.S., so I don't know all the Canadian restrictions and all that stuff. But as far as in the U.S., a couple of things. So one of the first things you mentioned was, I'm looking to grow the business. Where do I focus on? And above all, whenever I look at moving companies some that have scaled quickly and grown great and profitable, some that have been in business for 20 years and they're kind of stuck at a specific spot. All things considered, and generally, a lot of times the owners can even be very, very similar people, like very kind people. It's not like they're overly, negative in any way or they fail at certain skills or anything like that. What I've seen is it's brand above all, and you can have a bad brand and you do all the right things and it just doesn't work. So if I had to say something to invest in early on, it'd be invest in the brand somehow, right? And invest in community involvement. That's the benefit of a small moving company, especially a small local moving company where you are local to the company as the owner. You going out and networking is the greatest ROI you can ever have, because that pays dividends forever, right? Repeat and referral business is the cheapest business you can possibly have, right? And you can be throwing money at Google ads, but repeat and referral is vastly superior in any way to any source of marketing. So, trying to get to that next step, building that repeat and referral by just getting out in the community and giving back as a company, and then investing in your brand. Number one. But thinking about, all right, where do we go from here from a tax perspective, right? You can try to be fancy. So many times we tell our clients, we can make you pay zero in tax if you'd like. I mean, it's gonna be illegal, but we can get you to pay zero taxes. And a lot of accountants do. There's a lot of times we'll bring somebody on and we kind of look like the bad guys because we realize some of the horrible things that accountants have done to try to not show income, right? And the problem is it just doesn't hold up in court. You get audited and it goes through to not just a review, but like a full-blown audit, and they're going to sweep you off the floor, right? And so one, being competent in what you're allowed to do and not just looking at what's kind of the next trendy, TikTok advice, tax advice, bad news. And so I say all that to say, you can try as many things as you want. And in the end of the day, you have to realize what the government is after. The government is after you. I shouldn't say what the government is after. What is the government trying to promote? The government makes you pay taxes whenever you do things they're not trying to promote, and they allow you to save taxes when you're doing things that they are promoting. For example, if you're hiring people, if you're buying trucks, if you're buying real estate, if you're buying all these things and you're promoting GDP, the government's going to give you a tax break, right? And the biggest tax break you could ever ask for, and really the only one that has some sort of material difference, when I say material, I mean substantial, is depreciation, bar none depreciation. And to quickly say what depreciation is, if you pay $1,000 in marketing, right, you can expense $1,000 that year. If you buy a truck, a $100,000 truck, let's say, and you buy it all with a loan. Let's say you put $5,000 down. So, you paid $5,000. You got a loan for $95,000 to buy this truck. You can write off the entire truck in 1 year, right? And so if you have $100,000 in earnings, let's say you don't have any loans, you don't have any owner's draws or anything like that. We don't have to get into the accounting of it, but let's say your company had $100,000 in net operating income. It made $100,000 in cash, let's say. Okay. The government says that you should pay tax on $100,000. But if you pay $5,000 and buy a truck and have a $95,000 loan on this truck, now you can write the entire truck off, $100,000, and you pay zero tax. That is the only legal way to truly reduce your taxable liability. Now, is it tough to buy a truck every year to continue doing that? Yes, because
just going to say, what do you do? What do you do for year two? Yeah.
You buy another one, right? So how do you buy another one? You grow. So what does the government want you to do? The government wants you to grow. The government wants you to continue increasing their GDP, right? That's their whole goal. And so if you do increase your own internal GDP, right, the government gives you benefits for doing all that stuff. Now, there's a time where you have to pay the piper, whether that's you decide I'm happy where I'm at and I'm going to stop growing. Now the government says, okay, well, now it's time for you to pay, or you continuously grow, right? So if you want to reduce your tax liability, growth is the only way to do it. It's truly the only way. You can try to be fancy and use the Augusta rule and all sorts of things. But if you use it for a way that's contrary to what they ultimately decided to create the rule for, you're probably going to get caught. Generally, that's what we've seen anyway.
I like that one main tip. What about for the ones that say, well, okay, honestly, Brock, I don't have that kind of money. The bank's not going to give me that kind of money either to pull out and finance it. I mean, either way, I'm going to have to pay that back over X many years, or however I look at, financing that 95,000. So I'd rather lease, or I'm going to finance. Right. And then I also want to talk about being an employee or just being a dividend stakeholder within the business. What are some of the options on that? Because a lot of people say, okay, cool, my wife is going to lease a vehicle, I'm going to lease a vehicle, my salesperson is going to lease the vehicle. Is the government going to turn around and audit me and want kilometers for everything? Like, what does that look like as for writing off? Can I write off all the gas? Are they going to track me for just a certain distance? Or can I write everything off? What are those parts that I can write off when it comes to meals and leases and gas?
Talking about leases, my perspective, what I've seen, and people can disagree with this, but what I've seen is almost always it's best to own your vehicles. 70% of the cars that are purchased today in America are not actually purchased. They're bought on lease, right? And it seems over the past 10, 15 years, every car dealership or truck dealership has tried to push consumers towards leasing. And there's a reason that they've tried to push towards leasing, because it's more beneficial for them. They make more money on it, right? So if you can buy a truck that's either new or gently used, 100,000 miles, and you can use it for 5 to 10 years, you're going to get the best bang for your buck, bar none. That was a lot of B's, but you're going to absolutely maximize your profit on that. One, you can write it off much more upfront, right? So if you are planning to grow, you can take a lot more of the tax liability up front as you grow, right? You can't do that with a lease. You can only write off what you spend, right? But also, if you're getting a good truck with, we always say an Allison and a Cummins, you get an Allison transmission and a Cummins diesel. There is, that's the best thing you can get, and it's going to last you forever. Now, there are lemons, but you're going to have a truck that's going to be solid, that's going to be able to last a long time and allow you to maximize your costs, right? So generally, that's what we recommend when it comes down to purchasing or leasing or whatever, right? Now, going back to the tax piece, that's where we start getting into what we call an S corporation. And S corporations are very, very influential in both good and bad ways. For the most part, we recommend people become an S corporation when they're almost always at least averaging $50,000 of net income. Okay. And I'll talk about what an S corporation is and how it's beneficial. All right. So let's just say your company is netting $100,000 at the end of the year. You got, even after, depreciation and such, you're netting $100,000. You're walking away with a taxable liability of $100,000, right? So I'm sorry, a taxable wage of $100,000 flows into your personal. If it's just an LLC, it flows into your personal 1040, and you pay federal taxes, you pay Social Security and Medicare, you pay all those things on $100,000. Okay. Well, if you're an S corporation, you're required to have a payroll and you're required to have a reasonable wage. And there's lots of controversy over what actually a reasonable wage is, but let's just say a reasonable wage for you and your company is $50,000. Okay. Well, now you expense $50,000 through your company that you didn't before. Before, you just say took out $100,000. It didn't come off your income statement. It comes off your balance sheet, which is a whole nother conversation. But you don't expense.
That's for part two.
That's for part two. You don't expense your $100,000 when you pull it out of your company as an LLC, as a single member LLC, right? But now you're an S corporation, let's say, using the same scenario, and your wage is $50,000. You are paying the federal taxes and the Social Security and Medicare taxes on that $50,000. Okay. But when you're an S corporation, that other $50,000 earning that you have that is not wage is not subject to Social Security and Medicare, right? And Social Security and Medicare is 15.3%. So again, as a single member LLC, if you're not an S corporation, that $100,000 is subject to 15.3% tax, $15,300, right? If you're an S corporation and you take a $50,000 wage, your $50,000 wage is subject to the 15.3%, but the other 50 in company earnings is not subject to 15.3%. So it saves you 7.65% on your taxes, right? So on $100,000, on a $100,000
When should someone
wage,
turn around to switch? When does someone want to become an S corp?
generally when we say when at least your taxable wage is $50,000 in your business. That's generally what we say, right? Because if you're a CEO of a moving company and you're making $20,000 a year in W-2 wage, it's probably not reasonable, right?
You're doing something wrong.
You're doing something wrong. The government would audit you and they'd say that's not reasonable, right?
Right.
Now, $50,000 would be tough for them to argue that it's not reasonable, right? $50,000 is still a decent wage in the United States. I mean, you're not getting rich, but it'd be tough to argue that it's not a reasonable wage, right? So generally, we say when your company is netting $50,000 a year, then it probably makes sense to be an S corporation, right? But anyway, S corporation is the absolute best way to save taxes when you have a business, bar none.
You still didn't answer my last question, which was, do I put myself as an employee within the company or do I pull out dividends?
If you're a single member LLC, you can't have a wage. You can't be a W-2 of your own employee. Does that make sense?
Sure. To the Americans out there, yes. Canadians, we're looking at each other like, what? No, but yeah, okay. Go on.
In the United States, anyway, I don't know Canadian law, but in the United States, if you're a single member LLC, you don't take a wage, right? If you're a partnership, you don't take a wage. Generally, the four entity types we see, right, is it's going to be a single member LLC or a sole prop that can be treated similarly, a partnership, an S corporation, or a C corporation. Almost never recommend a C corporation. But the other three we see quite a bit, right? But a single member LLC or a partnership you don't take a wage in that. Only when you become an S corporation do you actually take a physical W-2 wage, right?
Okay.
Does that make sense?
Yeah, it does.
With whenever you are, like whatever entity you have, if you own a business, the U.S. government requires that you pay quarterly into the IRS. Basically, it's called quarterly estimated taxes, and your tax accountant should either set up automated payments with reminders. That's what we do, or give you literally paper vouchers where it tells you how much you need to pay in, which is kind of annoying. And every business owner doesn't pay them whenever they do that. So that's why we try to set people up automated, because then it comes down to tax time and they're like, oh yeah, I didn't pay those. Okay, well, one, you're going to get penalized. And two, now we got to pay it in, or now you owe $40,000 because you didn't pay in $10,000 a quarter, right? So, yeah.
You started at being a guy or a girl in the industry. I bought a truck, or I found a truck and started a moving company and got an LLC, and I figured it out. I've been really good because I've been, following along by all these other moving companies that I see on these Facebook pages and seeing what else everybody's doing. And I'm using Brock as my accountant. So I'm a win-win already. I have grown now to a $8 to $12 million company. I have 3 locations, and I'm going to you going, Brock, like, I wish I was back to 2-3 million. I was making money. I felt like I enjoyed the hustle. I now have all these locations. I had enough money to buy a warehouse, but the other 2 I'm leasing. I'm not making any money. I feel like this is crazy. My cash flow is sucked up. It's showing that I have profit. I'm still confused on what's cash flow and what's profit. Can you tell me, like, does this scenario come up when you're dealing with moving company owners? And what are you looking for? What are you sitting down with them going, all right, Mark, like, let's figure this out. And, oh, I see XYZ. These are your main problems. Like, what's the most common thing that you see coming up with moving companies that have now expanded going, dude, I am broke. Like, what is happening?
100%. We see it more than we like. And universally, I would say universally, its overhead cost. Okay. In that, they have substantially more potential than they are actually using, right? So in your scenario, doing $10 million for, out of 3 locations, those are big locations. Generally we would see if a company's doing 10 million, generally most of their locations are averaging between 1 and 1.5, maybe 2, right? Depending on where they're at. But generally that's what we've seen. Most of the time when you do that, you have a lot of administrative staff burden, right? So you have a lot of people on the back end that, to facilitate all these things. And most of the time that stems from not setting up the right processes when you're building it, right? Because you think about it, if you're able to build a really profitable $2 million company, then you should be able to build a massively profitable $4 million company. But from what I've seen, whenever these companies grow and double, let's say to 4 million, they do so at the expense of margin. So they massively increase what it actually takes to run the business. A lot of times we see it in administrative wage. There's a lot more administrative wage than it needs. And the big killer, generally when we start to see them, is like in your scenario, let's say they were at 8 million, they grew to 12, and then all of a sudden they backtrack to 8, the economy, fires, coronavirus, whatever it is, they backtrack to 8. Now they're operating as if they're doing 12. They have all the overhead as if they're doing 12, but now the revenue's 8, and there's not nearly enough gross margin to be able to cover those overhead costs. And that's when people get in trouble. So you really just have to make sure that if you are constricting, which sometimes you will, the industry will ebb and flow and your company will ebb and flow. And when you do, you have to make sure you pull back appropriately, or else that excess cost just destroys your net income. That's what we've seen for those larger companies.
Would you run that same scenario when we ask the question, hey, this is the moving industry, it is seasonal, we slow down around Christmas time, January, you asked me at the beginning, how is your January, and December, and I gave you my answer, and it's very common, which is starts off a bit slow in January, slowly picks up some momentum, but you still have all these hard fixed costs. I am still acting like I'm doing, 700,000-800,000 in August as I am in January, because guess what? The same employees are still working for me in the office. The same monthly rent is due. What now? I'm going to you going, Brock, help me. Like, how am I competing against this cash flow? What do you say?
One question that you asked me prior to this, you shot me an email, right? And I don't remember the exact wording, but it was something along the lines of what is some sort of financial insight that you would think is super beneficial for moving companies.
Oh, no, let me repeat it for you.
Do you have it? Yeah.
Here's the question. Here's the big one question. I generally don't send questions to my guests. And the reason for that is most of the times when I actually have 10 or 12 questions for my guests, I end up asking like 2. So they sit there studying all these questions and the conversations start flowing that even out of the 10 questions that I kind of had for Brock, because, financial statements, as much as I want to pretend in the last 20 years is a specialty of mine, it is not. And I am one of those guys that says, okay, I get it. I've made this much money. This is what my net is. This is what's in my bank. What's going on? Why is this not working? I've gotten a lot better, definitely, over the last 10 years. And I kind of know what my EBITDA is, and I understand my numbers to make sure that I am surviving and thriving at the same time. But the one question I said to him, because I want to make sure this gets answered, is what's one piece of financial advice you believe every moving company owner should live by?
I love that question, and I thought on it for a while. I'm glad you asked it, because I think if you would have asked, and I had to give you a question or an answer off the cuff, I think it might have been different. But what I would say, and this is true in all stages of any company, is the biggest cost of a company is potential. And let me tell you what that means. You talked about a moving company, that struggles during the winter, and then they they, maybe have a lot of sales during the summer and kind of increase their cash balance, and then that allows them to weather the storm in the winter until next summer, and then they get a cash balance. In January, you are paying the cost to be able to have sales of what you have in July, right? You have a warehouse, you maybe have trucks, you have admin staff, you have salesmen that are able to produce the sales that you have in July, but you're paying for them in January. So all of this cost that you have in potential is not being utilized, right? Alex Ramosi, I'm a big Alex Ramosi fan. He said something along the lines of, he was at a conference and somebody asked a member there, how much do you make? And they said $50,000. And he basically said, you are paying $950,000 a year by not knowing how to make $1 million, right? And it's the same concept of, you have this potential to have a moving company that, say, in the summer months, you're able to do $200,000 in revenue, but in January, when you're doing $70,000, you are still paying for a lot of that same potential. And so what I would say is, even though you have, and this may be controversial, but even though you have the ability to produce $200,000 in sales in July, I challenge my movers to try to not do $200,000 in July, but to try to massively increase their profit margin in July. So maybe you only do $150,000 in revenue as opposed to the 200 you could do. But if you lower your overhead cost to the point where you really can only service $150,000, but the $150,000 that you do is super high margin, then when it comes time to winter, you're not losing money because you don't have that ability to overproduce. You've constricted to the point where you're profitable at 70,000 and just insanely profitable at 150. Now your cash balance is rolling in, and now you can say, okay, how do I get to the point where I'm doing $150,000 in January, and I can do maybe not 300,000 in July, but maybe 250, right? And you just keep inching that up because, again, as a business owner, that when you go to hire your next staff member, that's coming out of your pocket, right? You personally are paying for that staff member, right? And so as you continue to do that, if you hire too much to where it's too burdensome during that winter period, that's where we see so many people get caught up in that pursuit of sales. I could care less about sales, right? Now there's a point where you can only make so much money with so many sales, right? But for the most part, I don't care about sales. I care, what is your net operating income? If you're doing a 2% net operating income, but you're doing $20 million, I'd rather you do $1 million and have a 20% net operating income, right? I'm not doing the math off of my head, but it probably comes out to be roughly the same amount with substantially less work. And again, that's what we see a lot of those big moving companies get caught up in, is they have the potential to do 12 million, but they only do 8 million, and all of their margin is gone now because of the cost of that potential. Does that make sense?
Totally. Yeah. It always reminds me of a conversation I had with a moving company owner, old timer, been in the industry for 56 years. And I had said to him, when I had purchased Salmons at the time where the revenue was, I said, I want this company to be a $10 million company. And he said to me, that sounds great, but if you realize that when the company was doing possibly 5 or 6 million and you had more money in the bank as opposed to when you do 10 million, come and talk to me then, because you're going to have a lot more overhead, a lot more expenses, and you want to make sure that you have fine-tuned all those extra expenses and costs, because the more money you think in sales that you're going to be making doesn't really play off of, it's nice to tell people, hey, cool, yeah, I'm an 8-figure business, or, even guys that, that do 9 figures, but there's really no money. They might have a shiny car in their driveway or a nice house, but really the amount of expenses that they have overkills the actual enjoyment and the revenue, the actual profit at the end of the day. So, I say that with a heat of warning to many young moving company owners that think, the grass is greener as you grow and expand. But if you don't do it right and smart from the beginning, there are a lot of key ways to to figure out where your numbers are, and you should know your numbers before you start expanding and growing. Brock, I don't want to end this because I want to kind of keep talking to you. What are some of the red flags that you've seen? Being in this industry, you obviously have a lot of experience working with different moving companies. You talked about working with a lot of companies that are that smaller niche, playing field, because you can start figuring out and almost building a playbook on this is what you need to do. But what are some of the most common red flags that you see that you're like, all right, guys, like we're stopping here. We need to reassess the situation. Can you share some of those experiences? You don't have to name any people, please do, but don't. Of those companies.
Are you saying from working with someone, or are you saying when I see that a company is probably going to have a tough time?
Both. I want to know, when do you see it where there's that red flag coming out where, hey, okay, we need to pull back the brakes, and share me some of those experiences. And also the ones where you've worked with companies and you looked at their books right off the bat and said, whoa, you need to stop this and let's focus on this. And what is that X and that Y?
100%. So one of the big things is we do not like when moving companies are using a lot of day labor and they're using a lot of like Cash App and Zelle and all that stuff, right? Those payment processors were not initially established to be business tools. And the IRS knows that, and the IRS doesn't like them. And so whenever we see someone that has a ton of Cash App and Zelle, a lot of times we're like, hey, I get it, but we need to set up a process that allows you to appropriately document this stuff, right? Appropriately send 1099s, let alone are you legally allowed to have a 1099 contractor. But if you are using contractors, we need to live above reproach and send in 1099s and collect the right data, right? So when we see clients like that, generally we're going to say, we recommend you using a payroll software. Even if you're paying contractors, you can pay them through a payroll software. That's going to prompt all the 1099s, the I-9s that you need. Software anymore is so advanced and makes it so easy that it should be pretty easy to
what
run
are some
your
of
business.
Sorry to interrupt. What are some of the softwares that you'd recommend to those that are listening? That may be inexpensive, easy to
100%.
use, at least for the
100%.
payroll.
I have, we have no affiliation with any software. I will say that. So I'm purely telling.
We know that we know you're getting affiliate, cuts and deals off this stuff.
No, no, I promise we're not getting any affiliation, but I recommend software because it makes our life so much easier. So some of the software we recommend for payroll, 100% Gusto, bar none, Gusto, bar none. It syncs into QuickBooks so well. It's so easy to use. The interface is easy. It allows us as a firm to have nice corporate access, to get access to clients. So nice. Gusto, 100%. Contractors or W-2 employees. And you can get some more advanced subscriptions that allow you to do HR and onboarding or whatever. Any company that I'm involved in, almost universally, we're using Gusto. It's just an easy software, right? So for payroll, I would say that. Payroll or contractors, I say Gusto.
When not knowing Gusto, I've heard of it, but I haven't looked into it. And so I want to see if you know the answer to this. What if there's a moving company that is paying their drivers? Because you talked about third party. Let's say I'm paying an owner operator or a third party company to do the job, and they're getting a percentage. So for every, these thumbs up keep like popping up on the screen here for those that are watching. The companies that I said, okay, great, here's a move. This is the move. It's $1,000. You're getting paid 65% of the job. That's your truck, your labor. And for me, I'm using something like Gusto that I have to pay this person through. Does it do percentages? Can I break that down when I am working out what costs I've paid out now for payroll?
So that's where your CRM is going to get involved, right? So, for a lot of moving companies, we're recommending Smart Moving. Smart Moving is a great software. It syncs into QuickBooks really nice, which is another software that we use and recommend highly. So in Smart Moving, for example, you can set up a contractor in the payroll function. It's not really payroll, but it's like time tracking, right? You can set them up to be a percentage of the job, right? And so that data export would allow you to then go into your Gusto or your payroll software to say, okay, John, who is truly an owner operator, we have a contract that he has his own trucks and moving equipment, maybe even his own guys, but we're paying him 65% of the job, you know, whatever. We track it and dispatch it in Smart Moving. We say we collect the payment in Smart Moving, whatever you're doing. But that will collect the data that you need then to say you go into Gusto or whatever payroll software you're using and say, okay, John is owed this, right? And there's one of my, I shouldn't even say that, a really good moving company that I like that's in Texas. They pay all of their guys percentage of the job. They don't pay hourly. Now they pay really well. So they never have to worry about, you know, not hitting minimum wage, which I know in like California can be a factor, but they pay every one of their direct laborers a percentage of the job, which is pretty cool because, you know, the harder you're working, the more you're making, and you get the right guys, and that's a really cool incentive.
Wow. Okay.
Mm-hmm.
I want more red flags. That was just like one.
Yeah.
Come on.
Let's see. Another, honestly, a red flag for a company that's going to succeed is debt. So we don't like we do not like a moving company to have over 15%. This is different than a lot of financial analysts or analysts or accountants will recommend. This is different. But we generally do not recommend more than 15% of sales as debt. So if you have a million in sales per year, generally we don't want more than $150,000 in debt. That's generally what we say.
And when you say debt, you're saying, hey, mover, you've taken a line of credit out for $200,000, and it seems as though that's pretty maxed out because you decided to get a line, or you pull the line on your credit card or wherever the situations are, and you've decided to buy a truck because you wanted the points and you got that big $150,000 credit card limit, but year ends come, you've only done $750,000 in sales and you owe $200,000.
Yeah. What we've seen is the more debt is a very, very, very delicate thing, right? Debt can be a fantastic tool, but it can also get out of hand really, really quickly. And so we do not want to see more than 15% of total sales in debt, only because we don't necessarily want we don't want it to get out of hand. It can easily become too much. And then if you have the slightest adjustment in economic trends or election trends or anything, and you backtrack a little bit in your sales, like we've seen a lot of people do in 2024, 2024 was a tough year for a lot of people. Now, all of a sudden, you might not be able to pay that debt load, or you're paying all your cash out for debt. Now you're in trouble. So that's why we don't really want to recommend or see more than 15% of sales in debt, right? Predominantly though, that's like truck loans, or if you buy a warehouse, like warehouse loans, but predominantly truck loans, right? Credit, we never want to see credit card debt. Never, ever. 0% of sales is the threshold for that. You can use a credit card, that's fine. Pay it off every month. Goodness gracious. Because it's like a 24% APR most of the time on that, and it just kills you. Never want to see the shark loans. Once we start seeing a company going into shark loans and things like that, it's like, man, we've got to get really serious about getting out of this, or else, the end is pretty nasty. So,
is there a book that you'd recommend for anybody to read, or some type of informational docket that you can say, yeah, like if you want to have a little bit more of an understanding, read this?
Oh man, I got a bunch of recommendations, but
you don't have to just give me one. I'll take a couple.
Okay, I'll give you two. I'll give you two.
All right.
Number one, man, bar none, as an entrepreneur, as a leader, mostly as a leader, is Jocko Willnick's Extreme Ownership. Bar none, the greatest book I've read on leadership and just what it, as a business owner, the mindset you need to have. Bar none, Extreme Ownership. To kind of summarize it quick, it's basically like And it's a great mindset to have. It's basically like everything is your fault. Like if you have an employee, if I have an employee that treats a customer bad, it's my fault. I should have put in the SOPs and such in place to make sure that my staff does not mistreat my customers, right? That's my fault. And so I need to do what it takes to make sure it doesn't happen, right? So extreme ownership, bar none. But like my favorite book forever has been The Richest Man of Babylon. Favorite book ever. I think there's a ton to take from that, which is basically kind of what we've been saying. Don't spend more than what you make. Don't spend more than what you make. Take what you can and reinvest it. And you know what? Here, you're an investor in your own company, in your own moving company. And so the money that you make, put back into the moving company, and continue to grow it. And if you're trying to look for other ways to invest it to make money, then you probably need to be hiring somebody smarter than you to run the company, right? You should be investing in yourself and in your company. And so The Richest Man of Babylon really, really talks about investing small pieces that you don't even feel back into your life or back into your company in this scenario to grow it and ultimately, build wealth ultimately.
Last but not least, we've talked a lot about P&L statements, understanding some numbers, where to go when you're in that red flag situation. But is there some type of Google Doc? Is there some type of Excel spreadsheet, some type of PDF fillable form that you have that has been created, or something that you can recommend for the moving company owner that's listening, that's starting off going, Brock, this was amazing, but hey man, like I still don't understand where I can start plugging in these numbers to understand. I am using Smart Moving, I'm seeing reports, I'm seeing everything else, but is there something that I can work on after hours that I can plug in some numbers of the fixed costs and the budgets and the sales to give me a better understanding of where I should be saving? Do you have something like that you can recommend, Brock?
I've created some simple videos, and like on our ProMover Instagram and Facebook page, we talk through some of these things. But as far as like plugging in numbers, there is a book that I would recommend to most, to every moving company that is now I'm gonna totally forget it. Oh, bro. I know I got it sitting like right here somewhere, but it's specific to the moving industry. I don't even have it. But it's a CFO book. It's written by, I knew you were going to ask me this and I totally forgot it. I'm going to have to get back to you on that. Shoot, I'm drawing a blank, a blank. That's my bad. But there's a book out there that's specifically for moving company owners. It's about being basically being.
Can I help you, Brock?
Can
Can I help you?
Yes. Yeah.
60-minute CFO.
Thank you.
The fast track to understanding finance for movers by Mr. David Drury.
So his daughter is also a kind of a co-writer in that book. And in that book, there's a downloadable Excel spreadsheet where you can put all of your information in. Now, it's a little advanced. I will say it's a little bit advanced, but that is
I've seen it downloadable. Okay. It is for those that are listening, it is advanced. Take your time.
Yeah.
When you look at it, you're like, oh, this feels like something out of 2003. It's not. It's definitely helpful, and Brock's on the right track here.
Yeah. It's great though. It truly is. And if you take the time to read it and listen to the theories and the concepts in there, you can get the numbers you need very, very much. Yes. 60-minute CFO. Highly recommend that as well. There's a third book for you, Mark.
Beauty. I didn't ask for it. Thanks a lot. No, I'm joking. That was a great time. I was wondering if you were going to mention that book. So, because I knew they had the Excel sheets as well in there, and it's very handy. So definitely check it out.
Yeah.
Hey guys, this has been an awesome episode, Brock. Thank you so much. I hope that when people look it up and say, ooh, Mark's talking to accountant, this is going to be super dry and boring, that this was very insightful and very entertaining. For those that want to understand more, learn more, please go check out ProMover Accounting online. message Brock. His contact information will be in the description below. For those that are listening to this episode pre-March 6th, Brock Hartzler will be on the Virtual Movers Conference March 6th from 11 a.m. to 5 p.m. Eastern. He will not be talking for 6 hours, but he will be in the hot seat. I am one of the moderators, and he's going to have to deal with me one more time. For those that are listening after March 6th to this episode, guess what? You missed it. And I'm sure you can probably find it online and recap watching that episode and see Brock on their talk as well. Brock, it's been a pleasure. Thank you so much for your time and being on the show.
Thank you, Mark. Loved it. Appreciate it.
And for everybody listening, you can catch us on Spotify, Apple Podcasts. You can find us everywhere, and also on YouTube if you want to sit back and relax and watch the video. And stay Movified, everybody.